If your retirement accounts have never been taxed, you don't fully own them. That $1 million IRA on your statement, a portion of it, maybe a large portion, doesn't belong to you. It belongs to the government. And they're going to tell you what their share is when they're ready. Today, we're going to talk about why that matters more now than it ever has and what smart families are doing about it.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. So here's what most people believe. They look at their 401k or their IRA and they see a number. Say it's $1 million, and they think, that's my retirement. Here's a reality. That money's never been taxed. The government let you defer it year after year after year, and in return, they became your silent partner. The deal you made was, I won't pay taxes now, I'll pay them later. The problem, you don't know the rate. The government gets to decide that in the year you take the money out. So if rates go up, and we believe they very well could, the value of that partnership interest goes up as well. So that $1 million in your statement might be $700,000. It all depends on what happens with tax rates between now and when you need it.
And here's what nobody likes to hear. That silent partner, they don't go away when you do. If you pass a tax-deferred IRA to your children, they inherit the tax bill along with it. Under current rules, they have to withdraw all of that money within 10 years of your passing. And when does that 10-year clock usually start? Well, during their highest earning years, their late 40s, 50s, and 60s. Actuarially speaking, that's just when kids inherit money. So every dollar they pull out of the inherited IRA stacks on top of their existing income. If they're already earning a good living, those distributions could push them into the higher tax brackets. And don't forget, in a lot of states, it's state taxable as well. So the inheritance you thought you were leaving, a significant chunk of it can go straight to the government.
Now let's compare that to a Roth. If you leave your children a Roth IRA, they still have to take the money out within 10 years. Same rule. But here's the difference. None of it is taxed. Let's say you left them $1 million in a Roth. Over 10 years, it grows to $2 million. They then move that $2 million into a regular account and pay zero taxes on the $1 million of growth. The only taxes they'll ever pay are on what that $2 million earns moving forward. That's a completely different inheritance. Same rule, dramatically different outcome for your family.
And it gets even better than that. A Roth doesn't have required minimum distributions. There's no age when the government taps you on the shoulder and says, you need to start taking the money out. With the traditional IRA, once you hit 73, which will ultimately go up to 75, depending on when you were born, the government says, all right, we've waited long enough, time to start writing us checks. And those required distributions, they count as income. They could push you into higher tax brackets. They could trigger additional Medicare surcharges. They stack on top of everything else. A Roth, none of that. You take money out when you choose, or you don't take it out at all. You let it grow, you pass it on to your kids, your choice. That's just not just a tax strategy, that's flexibility. We think flexibility is freedom, especially when it comes to retirement and taxes.
There's a well-known example that makes this point better than any hypothetical. A businessman converted his retirement account to a Roth when it was worth somewhere around $1.5 million. He paid the taxes on the conversion at that point, which were manageable. That account eventually grew to $5 billion, all of it tax-free. Had he kept it in a traditional IRA, at the highest federal rate alone before state taxes, the government share would have been nearly $2 billion. In a state like California, that Roth is worth the equivalent of almost $10 billion in a traditional account. That's an extreme example. You don't need to be a billionaire for this to matter. The principle's the same at every level. The earlier you convert, the more years left that money has to grow tax-free. Time is the multiplier. If you're realizing these are strategies in the tax code that nobody explained to you, subscribe, because this isn't the last one. There are more.
So here's the question people often ask. If a Roth is so great, why does everybody do it? Well, the answer is simple, because it costs something. It's painful. It's hard. The easy thing is to do nothing. Converting money from a traditional IRA to a Roth means that you have to pay the income tax now. And nobody likes writing the check. It feels to a lot of people like they're losing money. But think about it this way. Nobody likes debt either. And that's exactly what a tax-deferred account is. It's a debt you owe the government at a rate you don't control. So, would you rather know the rate and pay it now, or roll the dice and hope it's lower later? We think, and this is our professional opinion, that taxes are on sale right now. We are at historically low rates with record national debt. And at some point, something's going to have to give. So if we're right, then every dollar you convert today at today's rates is a dollar you'll never owe at tomorrow's higher rates. And every dollar you don't convert stays in the government's column.
And here's what makes this practical. You don't have to convert everything at once. The goal is what we call diversified tax buckets. You'll have some money in tax-deferred accounts, like your traditional IRA or your 401k. You'll have some money in taxable accounts, your brokerage account, for example, where you pay capital gains taxes and dividend tax. And ideally, you'll also have some in a tax-free bucket, your Roth. When you have all three, you can control how much tax you pay each year in retirement. You can pull from the Roth to stay below a bracket threshold. You can use it to avoid Medicare surcharges. You can blend income from different buckets to minimize what you owe. But without the third bucket, you're stuck. You take what the government tells you to take, when they tell you to take it, at whatever rate they decide.
And the thing about this is, even doing a piece matters. Maybe you convert a third, maybe a quarter, maybe 10%. But every dollar that moves from the tax-deferred column to the tax-free column is a dollar your family controls. Doing nothing, that's a plan, but it's not a plan near and dear to our hearts, because doing nothing doesn't mean nothing happens. It means you hand the decision over to the government, and they're going to the decision that makes the most sense for them, not for you.
So let's bring it all together. Your tax-deferred accounts have a silent partner. The partner's share grows every time rates go up. And when you pass those accounts to your children, they inherit the tax bill. A Roth changes the math completely. No required minimum distributions, tax-free growth, tax-free inheritance, and the flexibility to control your income in retirement rather than having it dictated to you. Flexibility is freedom, and the earlier you start moving money into that tax-free column, the more freedom your family has for decades. So if you're looking at your retirement accounts and wondering, how much of this is really mine and what should I be doing about it? That's a conversation worth having. Click the link below to schedule one, because investing is the easy part. Knowing what you actually own and protecting it, that's the hard part.
And if you're now thinking, all right, I'm convinced, but how do I actually get the money into the Roth? Especially if I earn too much to contribute directly, it's a good question, because there's a good chance someone told you that door was closed and it's not. The next video walks you through every path into a Roth, including a few most people don't even know exist. Click here and watch it now.